but the other meetings have been updated. Okay, so this is why I asked for only first name and location, just because it is recorded. Okay, so we're gonna go. Why don't we start? I'd like to open up with any questions. Does anybody have any questions? Vince, you didn't get the cash flow sheet? Is that what you mean? For the lease option. Right, right, right. Okay. Well, this week we got a lot of deals in the hopper, so I'm gonna go over them first. And Vince, if we have time, we can go over the lease option document. But thanks for reminding me. I appreciate that. Anybody else have any questions? Okay, great. Thanks, Rod. Okay, so let's go over tasks of the week. We did most of these, but just want to double check, right? So we're going to create a separate email. Most of you did that in class, which was awesome. Again, nice and easy and simple. We want that to be just our name, our email, and maybe property solutions or something like this in a phrase. Nothing more complicated than that, I think. When you're having those conversations, you'll be aware that they're looking for maybe some sort of particular information, and because of that, you can write down what that relationship is, whether it's an investor or a lease option, rent to own, foreclosure, whatever the discussion was about. That way you can control the conversation. That's important for us to do. And if you feel like the number is important at that particular time, you can give them your number, and this is why we create a separate number. Create a separate telephone number, as we just said. You can go to freephoneline.ca. You can go to Comwave. There's a bunch of them there. Or Skype even. Set up a number that you can start tracking. Again, separating your personal from your business, and then being able to do that to make sure that you make an immediate response, or at least fulfill the response commitment that you made to them. Create business card. We talked about this. Vistaprint. Steven says Staples has an opportunity for, I think it's $10, 250 cards. Did anybody get a chance to do business cards? Oh, good, good, excellent. Can I ask if it's okay? Where did you get that done? Staples, Vistaprint. Good, good, good stuff. Excellent, excellent. Okay. 41 with tax for 500. That's great. $13 for 100 cards. That's great. Good, good. So that's excellent. Create a business space in your home. Very important to make sure that you create a space that's nothing else we're going to do except business-related activities. Stay away from streaming or looking at videos. You want to make sure that that space is kind of sacred for your business, and that'll help you psychologically be more efficient when you get into that area. Okay. Obviously, keep all receipts for your taxes, and also concerning taxes, just pops in my head. My lawyer is going to join us next week, hopefully, to be able to help us out with contracts and agreements and talk a little bit about setting up those corporations. So that's what we're going to do for next week. And the week after, I will have again my financial advisor talking about mortgages and investments and stuff like that. Okay, so those are next couple weeks. Any questions about these tasks? Not for now. Okay. Anybody else? We're good. All right. Okay. So for the new group or anybody that doesn't have it, I want you to download these files. Just click on them. You'll be able to download them. Open each one to make sure that you're able to open them. So we have 6 key indicators, building your power team document, terms and conditions of a schedule. So terms and conditions, I talked to a couple of you about terms and conditions, and copy of cash flow sheet 4, which I sent to everybody, but you can take it a second time. Okay, can everybody download those? Open them up and make sure they're working. If you're working off a cell phone, I think you might have some challenges doing that. We've had in the past, but you can. I show these up every week. Maybe add another 1 or 2. We want to make sure. That you get them. Is my voice coming in through okay? Can you guys hear me okay? Yeah? Okay, that's good. If you do have a problem, please let me know. It's breaking. Any ways to turn it up? It's okay. Okay, let me see if I can get it louder, okay? Oh, I know why. Hold on a second. I know why. How about now? Yeah? I figured out what the problem was. Okay. So we don't need to turn it up louder, do we? Where can we access the CKIS indicator building your power team? Ed, just click on these files right here, buddy. See these files? See I'm highlighting them? Has everybody grabbed these files and opened them? They're right here. Can you guys not see that? I'm highlighting them. Can you see that? You just got to click on them like that. You can't see these? Everybody can't see this box that I'm moving around? Can you see it now? Okay. So download from there, okay? You still can't see, Lori? Your image is on day 4, yeah, that's right. But you see the box that I'm moving around? Can you see it now? You couldn't download the terms and conditions. The last 2 you couldn't download, these 2? Lori, can you see a box on your screen? No? Okay. Let's try this. What do you see now? Jeff, can you see it? But nothing's in it. Okay. Has anybody been able to download all 4 of these documents? You got it, all 4? It says cannot be opened. Where are you doing it from? Lori, where are you doing it from? A computer? A tablet. It might be the tablet then. It probably is the tablet. The tablet's restricting it. That's possible. You're downloading. Okay, Lori, send me an email right now, okay? Send me an email right now. And let's make a note. Okay. Make a note for Lori. Okay. I can download them later. Okay. So, Lori. Okay. So, Lori, Calgary, needs 6 key cash flow, building power team, and terms and conditions. Okay. Calgary, Lori, I'll send that to you, okay? Can you send an email? Ed, you can't get it either? Okay, no worries. If you can't modify them, it's okay. You can still watch, and we're going to go over it several times, so I wouldn't worry about it. But it's something to look at. This is the stuff I want you to look at and review, and we can answer questions up. Okay, Benny. Sure. Anybody else? So I got Lori, Ed, and Fenny that need the email. Anybody else? And Jeff from Calgary. Okay. Jeff from Calgary. Okay. All right. Oh, okay. If you use the TV, you can't see it either? I didn't know that. I sent you an email to Kevin. Okay. Kevin. Heidi. So I got Lori from Calgary, Ed from Calgary, Fenny from Vancouver, Jeff from Calgary, Heidi and Kevin from Calgary, right? Anybody else? Yeah, no. It's just 4 files. No. No. We're getting ahead. There's a bunch of files that I share. I just, we want to bring them in one at a time. Okay? All right. Okay, so let's look at the first file that I think we can start using. Okay, let's open the 6 key indicators. So everybody open up your 6 key indicators. Okay. Okay, I'm going to share my screen. Okay, can everybody see that? Okay, is that big enough for everybody? Okay, all right. So here we go. So this is just 6 key indicators that we can use to quickly analyze a property. We can get the asking price. Let's say the asking price is $130. The purchase price is 100. The number of units is 4. The gross revenue, which is the gross income from the property, right? So the rent is $20,000. So who's asking me to do that? I have not installed Excel 2000 yet. 2012, not so successful. Could you email that, please? Okay. It should have converted it. I'm surprised it didn't work for you, Rod. But so, Rod, you need which one? Which one you need, Rod? 6 key indicators. Okay, my friend. Okay. All right. Allow. Okay. All right. Okay. So can everybody see that? So 130, and then we have the purchase price of 100, 4 units. Pretty standard stuff. Nothing crazy there. Then we have the gross revenue, 20,000, and this is going to estimate a 35% expense ratio, which is good. If it's higher than that, we'll figure that out on another sheet. Let's say the expenses are, 35% of the number of units, of the gross revenue. Okay, and then we go down here and we see net operating income. So what does net operating income mean? It means that I paid all my bills, I paid all my expenses. So that's everything: taxes, maintenance, insurance, hydro, whatever the bills are. Every single bill you could including vacancy, all the bills. Okay. The net operating income is 13,000. Okay. So then we go over here and we see, okay, the bank's going to finance 75, seller financing 15%, 15,000, right? Because it's off 100,000. And then we have out of pocket 10%, which we talked about. This 10% is fine. More than that is not okay. So the total amount, 100,000, is accounted for. So this thing that you see down there is called James Bond. It's 007. That's a quick calculation to figure out what the financing will cost you. Okay? how much will it cost me to finance the property? Okay, so we see that the financing is going to cost us about $8,400. The cash flow, therefore, is going to be $4,600. You see how we got that? The 46. So there's the income, $13,000. That's going to be the financing cost, because $13,000 represents $20,000, which is the gross income, minus $7,000, which are the expenses. That's $13,000. That would be net operating income. But then we have financing over here, $8,400 off of $13,000. That leaves us $4,600. Is everybody with me? Okay, so it's important that if you don't understand what I'm saying or what I'm covering, please, I want you to ask the questions here, okay? I want you to make sure that you understand this stuff. Now, practice is what's going to make this work. It's important for us to do that. Okay, where did the gross income of $30K come from? Of $30K, the gross income is $20,000. So gross revenue, right? So that would be from the rents. So somebody says, and you can see this in listings, right, for rental property. Yeah, so the $20K, Ed, is from rents. So the income from the properties. So the total income from that property is $20,000 a year. That's gross, though, right? That's without expenses. Then we go down here and we see the expenses, and that leaves us the net operating income of $13,000. What if we put 20% from our pocket? As you said, it would not be more than 10. Now, here's the problem with that. So I'll explain that, okay? So I'll let you know, okay? Let's look at these key indicators. We'll look at that. So cost per unit is $25,000. Oops. Cost per unit is $25,000. I don't want you to really worry about that metric, because that could change city to city and the amount of units that you have, right? The more units, the lower that typically is going to be, okay? So don't worry too much about that metric. That's okay. Now, GRM is 5, okay? So what is GRM? GRM is, what GRM does is it says, look, if I pay $100,000 for this property, and my gross revenue is $20,000, how many times does my gross revenue go into my purchase price? So if my GRM is 5, it means what? It means that my gross revenue, right? My gross revenue of $20,000 goes into my purchase price 5 times. Does everybody understand that? So if someone comes up to you and says, hey, my property's $100,000, it makes $20,000 a year. You can quickly calculate the GRM, which is gross rent multiplier. Okay? So hold on one second here. The cash flow is per year. Yes. Yep. Cash flow is per year. What does GRM stand for? Gross rent multiplier. Gross rent multiplier. So what it's saying is, how many times do I have to multiply the gross rent to get the purchase price? So gross rent, $20,000 multiplier. All right? How many times more, how many times based on my income am I paying for the property? So 5 times my gross revenue is the value of the property. Does that make sense? Okay, any questions about that? Okay, so when the gross rent multiplier, just look at this one, okay, gross rent multiplier, let's highlight that one, gross rent multiplier is 5, that's good. So if the GRM is higher, no, so we want the GRM to be lower, not higher. Michael, let me explain why. If the GRM is higher, it means I'm going to have, my income is less versus my purchase price. Let me give you an example. So if this was 10,000, right, my GRM would be 10, which would mean that I'm paying 10 times the gross income for the property, right, 10 times.
and we want to pay less, right? If I put 20,000, it means I'm only paying 5 times my gross income. You see that? Yeah, it's okay. Most people think higher better. Yeah, it's okay. So you want your number to be lower because it's really based on income, right? So if the income to price the income's great on this property, that means the GRM is going to be lower, right? So does everybody understand that? So we want our GM to be around 6 or less, okay? For a quick calculation, somebody says I make, the purchase price is 100, gross revenue is 20, gross revenue is 20, sure. Purchase price is 100, gross revenue is 20. How many times my gross income, is the cost of the property? Does that make sense? So for me to make $20,000 in gross revenue, how much do I have to put up? How much money do I have to put up? Does that make sense? Is everybody good with that? So let's look at this. If my GRM, which is gross rent multiplier. Now, if my gross rent multiplier is, say, 5, 6, 7, okay? What does that mean? Well, if my gross rent multiplier, if my rent is, say, so we're going to go the rent, the gross rent, right? So that's a yearly rent, yearly gross rent. So if my yearly gross rent, just to give you an example so you understand the impact, my yearly gross rent, say, is $20,000. That's $200,000. $20,000. Okay. Okay, so that's dollars. $20,000. Okay. So what does that mean? Well, if my gross rent multiplier is 5, that means what? That equals this times 5. That means I'm paying $100,000. If my gross rent multiplier is 6, then that means what? It means equals this gross income times multiplier. I'm paying more. Does everybody see that? Does everybody see that? Equals this times this. So you can see each time it's getting higher and higher and higher. So, this represents what? This represents your purchase price down here, right? This down here represents our purchase price. So because of that, we want our gross rent multiplier to be smaller. What you're really asking for in this scenario is, what do I have to put up, right? What do I have to put up to make this gross rent multiplier, this gross rent of $20,000? What do I have to put up? Well, if it's a 5, I got to put up 100. If it's 6, I got to put up 120. If it's 7, I put up 140. So it's costing me more and more money to get what? That same 20,000. Does that make sense to everybody? So lower is better. Lower is better, right? Okay. Okay. Now, why is 6 kind of the number we're looking at for maximum? Now, why is that important? Why is this kind of a sweet spot? The reason is what's it, jack up the rent? You could increase the rent. That would affect your gross rent multiplier. We go 30,000 a year. Yep. It's going to go up, right? But your gross rent, your price is going to go up. Your gross rent multiplier, if it stays at 5. If we go back to the original 20,000 and I go gross rent multiplier of 4, you can see that it drops to 80,000. Okay? So the key here understanding is what? How much is it going to cost me to get that gross rent? What's it going to cost me to get the gross rent? That $20,000 per month, per year. What's going to cost me, it's going to cost me, if it's 6, it's going to cost me $120,000 a year. Okay? Now, that doesn't tell the whole story, but it gives us a good idea of value. And this is the reason why. If it's at a 6, the rest of your numbers tend to work out. Okay? To give you an example. So if your gross rent multiplier is 6 or less, your cap rate typically is 10 or higher. What's cap rate? Okay, so now we're looking at cap rate. So we're going to let that go to normal. We're going to go to cap rate. Now cap rate, this is the focus now. What is cap rate? Well, cap rate is establishing what is the return on my investment if I pay cash. What is my return? Hey, Zach, what's my return on investment if I pay cash for this house? Well, the house value is $100K, right? So we know, so if we go with cap rate, okay? So cap rate, it's basically saying cap rate really means, what does it mean? It means equals ROI on cash purchase of house, of home, right? Of property. Okay, does everybody understand what I'm saying? So it's a cash purchase on the property. Okay? That's an easy way to understand it. What does that mean? Well, we paid $100,000. So we go down here and we say, okay, the purchase price is $100K. Okay? Okay, so purchase price is $100K. Okay, good. What is my income? Well, my income isn't $20,000. Why isn't my income $20,000? Because that's my gross money. But I got to pay the expenses. So my gross income is what? $13,000. So if I go down here and I put in, okay, so I'm trying to get the return on investment. If my purchase price is $100 and my income, net operating income, which is basically your income, right? Your real income is $13,000, right? Do you remember how we calculated ROI, right? What's ROI? ROI equals what? Income divided by investment. Everybody get that, right? So income divided by investment. So equals income divided by investment. 13, which is as a percentage, would be what? 13%. Okay? Does everybody understand that? Does that make sense? It's all, yeah, you can understand this stuff. It's just stuff that's new to most people, right? Because they don't, they're not used to seeing this stuff, right? That's all it means. Purchase price, $100,000, net operating income, $13,000, return on investment, 13%. Okay? Okay? So what do we want that number to be, higher or lower? Do we want this number to be higher or lower? The cap rate. Because that ROI, that number 13, is what the cap rate is. Yeah, we want it to be higher. We want it to be higher, right? So what's going to make it go higher? Well, if I pay less, right, that's going to go up. That's one way. Pay less for the property. Because the income's the income, right, in this case. Or, if I'm $100,000, my other option is to what? Increase the income. That's going to make it go up. Okay? So this is why we're looking at getting good deals. Now, when the GRM over here is a 6, right? 6 GRM, you tend to have a cap rate, right? Which is the same as this, 15%. 15 cap rate. That's the same thing as saying 15 cap rate. What that does for us is it's going to get us 10, usually 10 or higher. So a 6 will get you at 10 or higher. Does that make sense? So I want you to think about this. the reason GRM is important is because with very little information, we can already look and say, this looks like a good opportunity. So if it's 6, I should continue to investigate, right? I should continue to investigate. So if it's a 6 6 GRM, right? The gross rental multiplier is 6. Then I'm probably going to have a decent cap rate, right? Which is 15 in this case. Well, we're just making up this number 15 because the real number of this is, what's the real number? Well, it's 13,000. So 13,000, right? If the GRM is 6, then the cap rate is going to be in that 10 range. Does that make sense to everybody? Okay, so with less information, we can still assess, hey, this is maybe a good opportunity, right? Let me get this closer. Oops. Okay. There we go. Okay. So we see the cap rate is 13. That's healthy. We want our cap rate to be higher, not lower. How can you trust the numbers you are given? Well, they can attempt to do that, and we don't want to worry about that. Okay, I don't want you to worry about that. What I want you to worry about is to be able to see an opportunity and get control of it. Through the due diligence, we'll find out if it's real or not. And if it's not real, we get out, right? Does everybody understand that? Right? Let's not assume anybody's lying to us. Let's assume we can protect ourselves. Let's know we can protect ourselves, right? We need to learn how to protect ourselves. People can say whatever they want, but at the end of the day, we need to proceed with safety. We want to make sure that we're safe, right? And that's how we ensure that we're safe, okay? So let's look at our value of the property. Now, our value of the property, that's how we estimate the value. We say it's worth $130,000. Where does that come from? Well, the way we evaluate property is this. What we say is, whatever the income is, the net income, right? Net income's $13,000. We multiply it by 10. Everybody get that? So whatever the net, whatever this number is, the net operating income, the net income, we multiply it by 10. Okay? So let's look at that for a second. So if we look at net income on a property, the net income on a property, let's say, I should move that over. The net income on a property versus value. Well, let's actually put cap rate. And then let's go over here, value. Okay, so the net income on this property is $13,000. Okay, so the cap rate, do you remember what cap rate we were looking for? What's the cap rate that we're looking for? Does anybody remember? What are we looking for cap rate? Well, that's GRM. 6, the Rebecca, that's the GRM. Wendy, we're looking, that's the amount we got. That's the amount we got. Okay, that's okay. That's okay. Let's go over here for a second so I can explain this. Okay. So cap rate is the return on investment for the purchase of the property. Okay? Not property, a property. Okay. Okay, so that's okay. So let's just make sure we understand this. Okay? So cap rate is the return on investment of the property. So cap rate, okay, let me just do this for a second to illustrate. Okay? Okay, so the cap rate on this property is 13. Okay, how did we get that? The purchase price is 100. The net operating income is 13,000. That's how much we make. The return on investment is 13%. Therefore, the cap rate is 13. Has everybody got that? The cap rate's not a percentage. It's not listed as a percentage, but you calculate it that way. Okay? All right, So what we want for a cap rate, if you look up here, what does it say? Cap rate 10 or higher. 10 or higher, cap rate. Okay, 10 or higher. Okay? So if we go over here and we say cap rate of 10, then what it does is it says, look, the value is going to be net operating income per year times the cap rate of 10. Everybody see that? So then the value of the property is 130. Net income, 13,000, cap rate of 10, 13. 130,000, okay? Okay, so what I want you to see is if you're always looking for a 10 cap rate, right, what do you learn? Well, let me just do something for you. So the cap rate's always going to be 10, and watch what happens when we adjust income. So let's say you raise the rent this year, and let's say it makes you $100 per month more, okay? This is how important it is to raise rent. If we raise the rent $100 on a 4-unit building, right, that'd be $400 a month. So my apologies, I won't do it that complicated. Let's say the rent, let's make it simple, okay? So the rent, okay, goes up $25 per unit. Just $25. That's not a lot. So $25 per unit. And how many units did we have? I don't like that there, but we had 4 units. Therefore, that's going to be how much per month? This times this is going to be $100. Everybody see that? So the rent went up $25. Let me just move this for a second. So the rent went up $25. It was 4 units, $100. Everybody see that? So if we do that per year, it equals this times 12. So we're going to bring in another $1,200 per month. Okay, sorry, per year. Does everybody see that? So rent, 4 units, $25 per unit, $100 a month, $1,200 a year. Does everybody see that? Good. Now, if I look at my net income, if my net income goes up at $1,200, so equals this plus this new money, okay? Now I'm making $14,200. My cap rate's still 10. What does the value of my property go to? Well, the value of my property goes to $142,000. You see that? There you go. Does everybody see that? How important it is? So it's important for us to continually raise that rent. And in cases where you can drop the rent, say you're trying to get a property rented out and you're finding it a challenge, you're better off keeping the rent where it is and giving an incentive for them to do it, like a TV or internet or something. Because that rent, once it's at a certain level, it can't, you can't really, you can't jump rents in most provinces, and some you can, Alberta you can, but most of them there's rent regulations. So rent is very important to us. What would be the other thing that would help us? Who can tell me? So raising rent and or what? And or, so rent's one way. What's another way? Lower purchase price, decrease purchase price. Yeah, let's assume you already have the property. So you have the property. What can you do? Well, I can raise the rent, but if there's regulations, I can only raise it to the regulation. The other option is what? Yes, decrease expenses. Excellent. So if we look at expenses, how do you spell expenses? Okay. So expenses are on this property were $7,000. There we go, $7,000. Okay. So expenses, we looked at expenses. Were $7,000. We have gross income. Okay, gross income was how much? $20,000. Okay, gross income was 20,000. Okay, so that gross income. That gave us a what? Net operating income of what? Well, it equals the income minus the expenses. Okay, that's where we get the 13,000. Okay. All right. Now, let's do this. I'm going to make this equal whatever this is. Okay. So 13,000. Now, if I can drop my expenses to 6,000, watch what happens. What happened to the value? Everybody see that? What happened to the value? It went from 130 to, what did it go to? It went from 130 to 140. Yeah. And that was why? Well, because my expenses were 7,000. I made them 6,000. That increased my value of the property. Everybody see that? Right? So why would we want to know what the value of the property is for us? Okay, so good question. So Michael, the value of the property to us is when you can pretty much sell the property anywhere in Canada based on this calculation and get that price. Okay? So once if the net income is 14,000 and the cap rate, your cap rate you're using is 10, that value of 140,000, you're pretty much you're guaranteed that price. You know, guaranteed. Now, not only that, Michael, that tells you the maximum you can pay. It's the maximum you can pay. Now, asset value, Vince, that's good. Asset value, though, that asset value is to investors only, not to the retail market. So let me give you an example. To the retail market, this property would be equals this times, just put it up here because you can see. The retail value is about 33 times in a Toronto. So if you were in Toronto or Calgary, downtown Toronto, Calgary, and your property made $1,400, $14,000 a year, that's what it would be worth. Everybody see that? Is there a big difference there? Yeah. Yeah, it's huge. It's huge. Yeah. Well, that's because, Vince, the cap rate for properties in metropolitan cities in Canada is around 3. It's 3. It's not 10, it's 3. That means 3% return, right? So if it's a 3% return, you'd have to multiply it by 33 to get 100. Does that make sense? Yeah. Yeah. Show you the whole spreadsheet? What do you mean? This up here? Is that what you mean? Okay. Yeah, we're just going one by one, so I explain what they are. So, does everybody understand now the value, the importance of cap rate? Anybody need more understanding about the cap rate? Everybody understands how cap rate is, how important it is, you know, how reducing expenses are important, how net operating income, you know, increasing the rent. In this case, we increased the rent, you know, by $25, and the impact was pretty big. You know, let's imagine that we could go $50. Look what happens. You know, it's $50. It goes from 160 to 140, to 164. Everybody see that? Let me show you. Let me highlight that one for you, this row, so you see it. Okay, so watch that row. This is what the property was worth originally, right? So if I have rent and I increase it by nothing, you can see it's 140, 14,000, the amount's the same. Everybody see that? Amount's the same. Okay? I don't get how we could buy a property in Toronto that's worth 140 for us. Okay. Okay. So let me explain. Lori, let me explain. A property in Toronto has a cap rate of 3, which is 33 times value. Okay? The reason that the property value in these markets is so high, right, is because in real estate, does everybody remember? In real estate, there's no money in real estate. You're not expected to make money actually from the property in income. You're not really supposed to make money. You're supposed to break even. You're supposed to pretty much break even. That's a good situation. So if a property you buy only produces 3% return, then the value is going to be 33 times income, okay, which is 462. Now, this is the problem with this story. These properties don't make money. They can be priced at $462,000, but at the end of the day, Lori, it doesn't make us any money. And we don't invest that way, right, Lori? We invest only if the property pays us. Does that make sense to everybody? So that's why it's so ridiculous for people to invest in properties like this. This property at 462 is going to lose money. You know, it's going to lose money for you, and people still do it. That's low for Toronto. Yeah, but that's the income. That's the income. That's based on income, remember. That's based on income. So in Toronto, the income might be a little bit higher. But the income doesn't have to go that much higher, right? Because inflation and expense will bring it down from 3 to 1 if the cap rate isn't 10. Well, Michael, the cap rate, yeah, the cap rate, it helps us because if we don't have a good cap rate, then we can't really do any creative financing. Okay, good. So it does not make sense. Yeah, you're right. It doesn't make sense. You're absolutely right. It doesn't make sense for us to touch that property. It doesn't make sense. But when you find a property in one of those markets, you know, like even downtown Calgary, the cap rate is probably going to be 5. So this is what that price would be in Calgary, about $280,000. You know, it's still, to us, it's still overpriced, right? Well, it's just not even a question of that, really, Hugo. It's that you won't find these deals. You won't find deals in this market. But if you see one of these that makes sense on the numbers, then jump on it. That's why the numbers keep us safe. That's why the numbers keep us safe. You know, so that's the important thing, right? Is to make sure that the numbers tell you the truth. Just wondering how to come up with cap rate percentage. Cap rate percentage? What do you mean by that, Vince? Remember what cap rate is, right? So if we look over here, we did that over here, right? So cap rate is return on investment of cash purchase of property. So if the purchase price is $100,000 and the net operating income is $13,000, then the return on the investment is 13. Cap rate just says, it doesn't say 13%, it says 13. Just says 13. But it's the same exact thing. It's the same exact thing. Okay? So when you hear a 10 cap rate, that means you're making 10% if you paid cash. If you are 15% cap rate, 15 cap rate means you're making 15% if you paid cash. The reason we don't say that is because nobody's really paying cash for property. So when we say return on investment, we mean this. We mean cash on cash return, right? Cash on cash return, which means what? How much money did I put in and how much did I make on that money? What was my return? 46% in this case, okay? All right? So the value of the property, everyone understands how we evaluate that, right? The value of the property? Okay? Good. We're learning, yes? We're learning. This is how we do it. Step by step together. And don't worry, you can ask the other students that have been on this call for a while. We go over this stuff all the time, over and over again. So don't feel bad if you're not completely getting it. repetition. We do this all the time, except, we like to do it with deals. Yeah, Wayne. Yeah. Okay. So cash flow per month. Okay, cash flow per month. Okay, $75. Well, how does that work out? Pretty simple. Cash flow per month is what? Well, I take my net operating income, $13,000, right? $13,000, and I divide it by 12, right? $13,000 for 12. Why do we use 10, not 13 for cap rate? Because, Ed, for us, 10 is the minimum we'd like to see. That's why. Remember, why do we like the 10, folks? Why do we like the 10? 10 means we're going to make money. And we can do creative financing. GRM, why do we like the 6 GRM? GRM is 6, usually produces a cap rate of about 10, therefore we're going to make some money, right? And you can look and you can see the cash flow per unit on this property is $95, okay? Our minimum is $75. So these metrics are there to protect us, to make sure that, that we're spending our energy in the right place. So the first thing that you get as an investor, the easiest thing to calculate because it has the least amount of information, is GRM. If the GRM is 6, what does that mean? Well, let's spend more time on this. This looks like it's an opportunity. Let's spend some more time on this. If it's an 8 cap rate, if the GRM is 8, that's okay. We might be able to work with that, but just let me give you an example. So everyone sees that the GRM is 5. Everybody sees that, right? Let's go over here. I'm going to make this a different color. If we see the GRM is 5. Watch what happens when this GRM goes up to 8. Watch what happens to these numbers. Cap rate's 13, value's 130. We're making $95 a month per unit, okay? Per unit, per door. And the cash on cash is 46. This is pretty healthy. Watch what happens when I change the GRM, because what? I changed the price. So the price now goes from 100 to 150, okay? Look what happened. GRM is now 7.5. Higher is not good, right? Cap rate dropped from 10 to 8.7. The value didn't change because the net operating didn't change, right? The net operating. But and we go down here and we see what? Cash flow per unit. How much? $8. $8. Cash on cash return, 2.7%. You see what happened? Everybody see what happened? Yeah. So when your GRM is say 7.5 or 8, we can negotiate the price down. Yeah, it's huge. We can make it. We can possibly make it work, right? We can maybe make the numbers work, right? So now we're sitting at 5, but we could go as high as say 120. So we're 6. See that? 6, 10.8, $60.24. This needs to be a little bit higher, so we want the income to be a little higher, but the return is double digits. That's good. So the only number that's weak here is what? This one. This one. But look, 6 produced a 10. Now this becomes a question of costs or income, right? Everybody see that? Does everybody understand? We're good? Okay. So the GRM is important. The cap rate is a function of what? The cap rate is a function of cost versus income. Remember? So this real income that we make divided by the cost, that gives us the cap rate. Okay? So 10.8% return basically, which gives us a value of $130,000. If we're looking at a property that's $120,000 and we're getting it for it's worth $130 to us and we're getting it for $120, that means there's $10,000 equity in the property right off the hop. Does everybody see that? Everybody understand? Yeah, that's right, Jeff. Reduce our expenses, absolutely. That's gonna make it better for us, because if the expenses go down, that's gonna produce more money at the end of it, right? Okay. So per unit, how much are we making per unit? We take this. So let me do this for a second. Now see what happened? I changed the number of units to 3, right? I changed the number of units to 3, and look what happened, right? They went $81. Why? Well, there's less doors. Does that make sense? There's less doors. We're dividing it by less doors. If this was 2, what's going to happen? Number is going to go up to 163. Does everybody see that? Right, so obviously the less the doors, the higher per door, which is fine. That's not anything interesting. What's important is we need a number to say what's the bare minimum. So in this case it's 75. So let's leave that at 3 because it's there. That's going to give us $81. We're good. Okay? Everybody see that? Everybody understand that? We're good? Okay, good. Cash on cash return. Where does that come from? Well, how much cash did we put on this property? So we put $12,000. Well, this was because I changed this, so let's change this to $100,000. In this case, I put $10,000 out of pocket, so that's my down payment. So if I put in $10,000, right? So let's go down here so we can look at it again as a separate, you know. So okay, so down payment. Okay, and then we got cash flow, which is going to be net operating income, and then we're going to go ROI. ROI. Everybody good? Okay. Down payment in this case was $10,000. The net operating income is what? Well, you have to look at how much does it cost me? What's my gross revenue? $20,000. My expenses are $7,000. My net operating income is $13,000. Everybody see that? Gross money, gross income from rents, expenses to carry the property, that's insurance. Pity, it's principal, interest, taxes, insurance, plus vacancy, plus maintenance, plus property management. We make $13,000 a year. So when we come back down here, we see, okay, so my down payment was $10,000. My net operating income was $13,000. Okay, my return on investment equals what? Income, net operating income divided by investment. Let me just double check something because we just made $13,000, which is right. We made $13,000. Out of pocket was only $10,000. Give me a second. Here. Oh, my apologies. That's why. Okay. For out of pocket is $10,000. That's correct. My apologies. So the net operating income is $13,000, but we don't get to keep that all. Why? Can anybody tell me? I forgot about that. Why? What is there what has to come off of this? Who can tell me? We don't get to keep the full $13,000. What do we got to take off? Yeah, carrying costs, right? There's $4,600. So let's go over here. That's the carrying cost. So let's look at that carrying cost. It wasn't 46. So net operating income. So let's make another insert. We're going to go right. Okay, so this is going to be carrying cost. Okay, so the carrying cost on this is how much? It is $8,400. Right? $8,400. Okay? So $8,400 is what it costs us to mortgage this property the way we got it set up. Okay? So that means that the net operating income minus the carrying cost is, let's just move these closer because let me do that. Okay, so I'm going to move this ROI over. And that's going to go to the right. And the reason is I want to do this. So net carrying costs. Let's make that centered. That's better. Okay. So carrying costs. Then we have cash flow. Right? Everybody see that? Right. That's the cash flow per year. So I take the net operating income. I minus the carrying cost. That's what I make in cash flow. Yes? Equals, so what does it equal? ROI equals income divided by investment. That's 46. As a percentage, it'd be 46%. So carrying cost is the mortgage, the loans. So debt, it's really debt service, or debt service is another name for it. But carrying cost, I'm just saying debt carrying cost. Debt, not expenses, but debt carrying cost. Okay? To carry the debt, it's costing us $8,400 a year. Okay? Does that make sense? Okay, does everybody see that? Okay, I want you to see something. Okay? So let's do this. Let me show you something. So what if we only had to put 5,000? See what happens? The debt, the ROI doubles, right? But that's not fair because I'm adding 5,000 in carrying costs, right? So $5,000 in carrying cost might cost me another $100 per month. So that's $1,200. Let's go 90, 9,600. Look what happens. Everybody see that? So yeah, your debt would be more. Yeah, your debt would be more. Yep. But do you see the relationship? Income's income, right? Income's income. But if you move the down payment down, your debt carrying cost is going to go up. But your cash flow is going to go down. But we talked about this. What goes up? Your ROI. Now, why is that important? Well, it's important. Yeah, OPM. We want to use OPM. Because if I only use $5,000 to make $3,400, right? In this case, I use $10,000 to make $4,600. What if I did it? What if I did this twice? Look what happens. Instead of me using $10,000 to make $46,000, I used $5,000 on two investments to make me $34,000 and $34,000, right? I'm just going to separate that. What does that mean? Well, it means that I made, what does it mean? On the same amount of money, I made $6,800 instead of $4,600. Does everybody see that? Everybody see how important that is? It's a big, big deal. This is huge. Yeah, it's huge. It's huge. So we've been taught to do what? Put bigger down payments down. Bigger down payments down. Net operating income is what it is. Net operating income. But the down payment is where we can change things. And yes, it will be a higher carrying cost. And yes, the cash flow will be lower, but the return will be higher. And because of that, we need less money to make more. Everybody see that? Now, what if I change this? I don't want it to go to zero, but what if I change it to $1,000? Look at that. 340%. Now, the carrying cost is going to go up. But let me show you something. Hold a second. Oops. Okay. So let's put this back to 5,000. Now look at this. Check this out. I've done this in class, but I want you to see it. Could I, now that I've got this investment at 5,000, this one, right? Let's make that green. Could I give somebody an opportunity to get into this deal with me, $5,000, right, and pay them 20%, well, let's say 10% is the going rate, but I could go as high as 20, but 10% is what the return. What's that going to cost me a year? $500. Everybody see that? So I go to Lucy. Lucy, do you want to make 10% on your $5,000? I'll pay you $500 a year, right? 10%. 10% is a good return, right? 10% is a good return. Let's go 20%, right? Equals this times this, and let's just change this to a percentage right here. Okay. So look, $5,000 a year, 20%, I'll give you $1,000. If I can take this $5,000 out of this deal here, right? I'm still going to make how much? $2,400. $2,400, right? So now I'm making $2,400, right? Because I got to take it off the 34, right? $2,400. I've given her $1,000 a year, 24. But how much do I have in? 0. I have 0 in equals income divided by investment, infinite. That's an error, but it means infinite. Everybody see that? Does everybody understand that? So when you do better, you can offer better things to the people you work with, the people that are going to do business with you, right? This is why it's important for us to put less, not more, but less. And if we don't have a cap rate, right, of 10, remember what cap rate means? What's cap rate mean? Cap rate is 10, right? That means what? What's the same way of saying what? Cap rate, same thing as saying, hey, we're making 13% investment, on this investment. Why is that important? And yeah, right. And why is that important? Well, if we don't have a 10 cap rate, let's just make this a 10 so everybody can see. So the cap rate's a 10. Why is this important when we're looking at real estate? Well, when we're looking at real estate, the 10 cap rate's important because we know that we're not going to pay cash for this property, right? We all know that, right? So we need a 10 to make sense of the deal. Why? Because if the property produces a 10% return, I could go as high as 7%, even higher, but let's just say 7% interest on a loan, 7% interest on the mortgage, and I'd still make money. Does everybody understand? So if my interest to carry this property was as high as 7%, what's the current interest rate? 3? If I could get interest as high as 7%, I could still make this property make me money. Why? Because if I'm making 10 and I'm paying 7, it's more than 3, but 3. Does everybody see that? Does everybody understand why that's important? Yeah, it's really, really important. Yeah. And why do I want the creative financing? Why do I want creative financing? Who can tell me? Well, I want creative financing because the less I put in, the better I do. The less I put in, the better I do. So I want to have a property that's going to allow me to put very little in and make a great return. You can't do that with properties that are, income's $1,400 and the property's price is $280,000. The cap rate's too small. Can anybody tell me the cap rate on this one? At $280,000, the cap rate is. Anybody know? What's the cap rate? It's 5. Yep, it's 5. You see that? It's 5. So the return on this would only be 5%, right? Is everybody with me? I want you to get lost. But this means that we're only making 5%. How did I get that? Well, look. Income divided by what? Investment. Income divided by investment. Everybody see that? Yeah. So look. If the property value, if I had to pay $280,000 for this property, and I was only making $1,400, that would mean that my cap rate or return would be 5%. Does everybody see that? Right? Now I want to pay $140 because if I pay $140, my cap rate's 10. But if I pay $280, my cap rate's only 5. Well, what's the problem with that? What's the problem with getting a 5 cap rate or 5% return? Well, the problem is when it comes to creative financing, I'm in trouble, right? Sorry. When it comes to creative financing, if this cap rate's only 5, I'm in trouble. So if the purchase price is $100, I'm only making $5,000. My cap rate's only 5. I can't carry the property as high as 7%. Why? I'll lose money, right? I'll lose money, right? I'm going to lose money. I'm going to end up losing money because the cost of carrying it is going to be greater than the actual return I make. So that's a problem. So the cap rate needs to be a 10 so we can get creative. Now, one more trick question here. Think about this. If interest rates, if mortgages were at 10% a year, could we use a 10 cap rate? No, right? Does everybody understand? If the interest per year was 10, I couldn't use a 10 cap rate, I'd lose. So the cap rate's going to go higher as interest rates go higher. We'll need a higher cap rate. Does that make sense to everybody? So if the interest rates go up, our cap rates have to go up. And just to give you an idea of what does 7% interest represent, right? Yeah, the cap rate, yeah. And as a rule, Jeff, I'd say that, you want to be, the easy one is just to go interest rate plus, mortgage rate plus 7, right? Mortgage rate plus 7. You're fine. Yeah. We want at least 20% cap rate if the interest is 10. You don't have to go that high, but that would be excellent. Yeah, that would be excellent. As a rule, just a general rule, you can say interest plus 7. Interest plus 7, that'll tell you where your cap rate needs to be. So mortgage rate plus 7. Mortgage rate 3, cap rate 10. Mortgage rate 5, cap rate 12. Does that make sense? Okay, just as a general rule. Just a quick calculation. So how important is this interest rate? What does that represent? Just to give you an idea, I'll show you another sheet. Don't worry about the sheet. Just I want to show you an example, okay? If I use this over here, just to give you an example. This is a similar sheet. I don't want you to worry about it. It's not important, okay? So the bank, this is $100,000, similar to the other sheet. The bank is, we're going to put up 75%, 75,000 with the bank, 15 from the seller, and 10 for us. So if I do a 25-year mortgage, check this out. If I do a 25-year mortgage at 8%, that's going to cost me $527 a month, $6,800 a year. But we know what? This is 3, right? We know 3. So that portion from the bank is going to cost you how much? $354, and the yearly is $42.59. Is everybody with me? Okay. So let's do this. Let's say this seller financing, which is $15,000, it's going to be 25 years. It's going to be 10%. Right? So that's the seller. We say to the seller, put up financing for us. We'll give you as high as 10%, which is outstanding. That costs you another $134 a month, $1,600 a year. Okay? Does everybody see that? Okay. So that is going to be $5,869.29 a year. Does everybody see that? Everybody sees that, right? Okay. So just to give you a quick calculation of what that means. What that means, that this 3 and this 10, what does that mean as an interest rate over the whole loan? Both of these. Does it mean we're paying the average? No, it doesn't mean we're paying the average. Because the larger amount is being paid at 3%, the smaller amount at 10%. So what is the real interest rate, roughly, that we're paying? Well, a simple way to figure it out, it's not exactly accurate because it's an amortization table. The simplest way to figure that out is to go, well, actually, I can figure it out. Let me show you. 25 years. Let's go 25 years, and let's go, I'm going to do a reverse calculation here. 25 years. Oh, that might be too complicated here. Let's do this. I'll do it this way. To give you an idea, what would it be? How much did we borrow, folks? How much did we borrow? We borrowed $90,000. Does everybody see that? We borrowed $90,000. Okay? So if I borrow $90,000, and this is the challenge with this. This isn't absolutely accurate because some of this is principal. And it costs me this much money, $5,896 to carry $90,000. What is my interest that I'm paying? Well, I would take what? This divided by this, it would be 7. You see that? It's less than 7, but do you see that? It's 6.5. Does everybody understand what I just did there? Well, I'm basically saying, what's the real interest rate? Well, it's about 6.5. It's less than 6.5. But because even though this is 3 and this is 10, 6.5, it's actually less than that, I'd be paying. I'd really like to actually work out what it'd be, because now it's kind of irking me, because I know it's less than 6.5. So let's do this. Let me do this for a second. Let's change this to 90%. There we go. Let's go 25, and let's go 25 at 5. Okay, let me see what I'm doing here. Hold on one second. I'll tell you what it means after I do it, okay? So, equals sum this equals that and that. So it's actually less. 4.25. There it is. That's your number, 4.25. The actual interest that we're paying is 4.25. Okay? Let me explain what I did. Okay? So what I did is I added these up, right, which is $5,869. Okay? Okay? I added these up. That's what's costing me per year. And then what I did, this amount is 90,000, right? 75 and 15. Then all I did is I said, well, what if it's 90,000? Well, 90,000 over 25 years at 4.25% gives me what? This number. So now this number is pretty much the same as this number. Does everybody see that? That's how I found out. That was just a quick way to do it. So the real interest is 4.25. So check that out. We paid 3% for the first and as high as 10 for the second, and we're only paying really 4.25 interest on the whole amount. Does everybody see that? If we're only paying 4.25 and our cap rate's 10, we're in great shape. We're in great shape. Does that make sense to everybody? Did anybody get lost in that last little calculation that I did? It's okay if you did. Yes? Okay. So this is what I did, folks. This is what I did. I'll break it down slower, okay? So this here represents the number of years and the percentage, okay? Second means it's a second person holding the loan. The loan. So let me do this, folks. Let me move. I'll put some things in here. Okay, here we go. Look, this is amortization, right? So the length of loan. How many years, right? This is interest. Okay? This is monthly. And this is yearly. Okay? Everybody with me? Okay. So let me move this out of the way for a second. Put it there for now. Okay. It's okay. So, if we, and let me do this, just to fix this up. Okay. Okay. So here. Okay, here we go. So does everybody see that? Okay. So this represents what? And here I'll just move. I'm just going to make one more adjustment for you, so you stay with me. Insert. Let's go right to give you an idea of where these numbers came from. Here. Let's do this. Don't worry about that for now. Let's go down here so we can see it. You know what I should do? I should move it to another page, but that's okay. There. Okay. Don't worry about it. I'll make it make sense in a second. Okay? So let's do this. This equals, this is here, is the loan itself. So let's look at the loan. The loan. Okay? so you have a better idea of what am I talking about. Okay. So the loan in this first loan was how much? Who can tell me? Remember? 75,000. So 75,000, so just go like this, equals 75,000. This loan was the second mortgage at 15,000. Everybody see that? So the loan was 75. At 25 years, let me just open that up. At 25 years, a length of a loan, the interest at 3%, that's your monthly, that's your yearly. Has everybody got that? The loan at 15, which, Michael, is your second loan. That's your second. So second mortgage just means the second loan on it. The order just means who has power over getting their money first if things go wrong. So the first position loan, which is the bank, gets their money first. This guy gets his money second. So the loan's 75. The length of the loan is 25. The interest is 3%. This is your monthly payment. This is your yearly. The 15,000, right? We pay 25 years. We're going to give the guy 10%. We're going to pay him $134. What does all that mean? Well, it means every month I'm paying $489.11. Yearly, I'm paying $5,869. Everybody see that? That makes sense, yes? Good. All right. Okay. So what did I do down here? Let's move this over too. What did I do down here? Well, I said, what if the loan was 90,000? Okay? If the loan is 90,000, 90,000, which is the same as this, right? Right? If we sum these, it's 90,000. So I'm trying to figure out, because these are two different interests, what's my real interest? Right? What's my real interest? Well, 90,000, let's see what happens. How do I get, what I'm trying to get is produce the same numbers as this down here, right? So I'm trying to get these numbers to match these numbers. That's what I'm trying to do, okay? So if I go 90,000 at 25 years at 4.25, they're almost the same, right? Almost the same, and the end year is almost the same. So what I'm saying is, even though these are different, the real interest that I'm paying on the whole amount is 4.25. Does that make sense? Good. All right, we're learning, yes? Okay. So why is that? Let's try one more. Okay. Let's try one more thing. Why is that important? Because the cost of carrying this property is going to affect what? It's going to affect, other sheet, it's going to affect my cap rate, right? So if this is 10,000, let's go back to here, 10,000, I'm making 10% cap rate. Can I afford to pay 4.5%? Sure I can. Sure I can, right? And what I'm trying to do, what just happened? Oops. Oh. Sorry about that. Here, I gotta find you guys now. Oh no. Oh. You guys can still see that, right? But I gotta be able to see you and your question. Okay. I gotta get out of that for a second. So I'm gonna stop sharing. It's okay. Okay. Can you guys see the empty screen now, right? Okay, we're back. Yes? Everybody see that? We're good again? Okay, good. So, can I afford to pay 4.5%? Yeah, I can. If I'm making 10 cap rate, 10%, I can afford to carry at 4.5%. I can make this work. I can make this work. And keep in mind, how hard, really, be honest, how hard is it going to be to get money for down payments and loans when you're paying 10%? How tough is that going to be? Right? Yeah, it is. It absolutely is genius. How hard is it going to be for us to offer these? Yeah, not hard. Not hard. Yeah, it's not hard. Money's not the problem, folks. What's the problem? Money's not the problem, because we can offer great returns. The problem, or the challenge more specifically, is, look, we need to be aggressive and specific and particular about the prices the properties that we're getting. Yeah, and sharing the wealth. You're right, Justin, Jamie. Yeah, this is why, and this is the irony of it. This is the irony of it. If you don't do it this way, if you don't actually, approach it from this way, you can't make money. Yeah, it sucks, sir, Jeff. That's right. If you can't find properties that actually produce a good cap rate, you're going to lose money. You're going to lose money. And you're not going to make any money. We can't pay, we can't go out there and go to markets and justify this right here, justify this insanity where we're looking at properties and we're saying it's worth this much. People are telling us it's worth this much, $280,000. Well, $280,000, nobody's making money except two. Who's making money? Wow. The renter's happy. It's a nice place. The bank's making money on interest, sure. The seller's making money, sure. The tax man's happy. He's making money, right? But what about us? Why would we even touch this property if we can't make any money? The only way that we would think it was a good idea is what? Well, we think, well, I'm paying $280 now, but in 20 years it's going to double. It's going to be worth more. But who cares? You're going to take the risk of waiting 20 years or 25 years. That's too dangerous. Okay. But what if we make a few of those? Won't the banks tell us you have too much liability? We can't lend to your money because we only put $5,000 down, but borrowing the rest is mortgage, right? So actually, no. Let me say this. That's a bigger question than you think, Lori, that you're asking. That's good. So I want you to keep this in mind. The way we invest, are the banks happier or they don't like us? Do they like us or not like us, the way we invest? The banks like us? Yeah, they love us. Why do they love us? Yeah, they're making money. Not only that, they love it because at the end of the day, the banks love us because they know we can pay our bills. Why? Because we're profitable. We're very, very profitable. We don't do investments unless we're profitable. And if they know that you're coming to them with an investment and they know you're going to be able to cover the bills and you have money left over, they love you. When you go to the bank and you show them that the property is going to lose $200 a month, well, that makes them nervous after their third property. That makes them real nervous. But if every property we bring them makes us money and them money, they know it's sustainable. Does that make sense, Lori? It makes it sustainable. Now, the other part of your question that you're saying is important. Is important. Yeah, absolutely. You got to look at other people getting you mortgage, right? We can use creative financing to bridge mortgages too, right? But the other part of your question is important in that, are banks going to be okay with us coming up with 10%? Well, some mortgage brokers or institutions are okay with you putting only 10%, right? Remember those rules. So we convinced them with the investment plan, basically. Lori, you don't even have to convince them anything. Show them the numbers. That's how they get convinced. But you're absolutely right. They're going to be convinced by the numbers, right? We don't have to. I mean, the numbers, right? Yeah. So will banks work with us at a 10%? Well, business, yeah. Residential, when I say residential, I mean, I should have said more like consumer to do it. It's a little bit tougher because the consumer's not going to come up with that. But there are lenders out there that'll work with you. But even if we don't find lenders, like institutional lenders, what can we do? We can what? We can just do what we did on the first one. Borrow it from somebody else. If you're offering somebody 10%, why not? Right? Why not? Yeah, seller financing, private money, hard money. There's a lot of people on this call right now. I already know. I know because I've talked to them that have money sitting there waiting to lend it at the right return. I know it. There's people on this call right now, this group. So there's money everywhere. Make no mistake. There's tons of money out there. it's just a question of us, offering the fair, fair maybe is not the best word, but better than competitive returns for our investors and make them happy too. Okay, so I'm going to get out of this screen for a second, and what I wanted to do was just a quick. Let me see. How many of you were at the symposium last week or a couple weeks ago? Yeah, good. Okay, I remember talking to a few of you from that event, and you telling me everybody's walking up to everyone else saying, "I got money, you got a deal." Is this true? Yes? Everyone had money. There was money everywhere. That was never the problem. Yeah. And I want everyone to see that. Folks, there's money everywhere. At our symposium we had in Vancouver, which was 2 weeks ago, we had to take 150, 160 students taking classes. There was money everywhere. People had money. That wasn't the problem. People were looking for opportunities and deals. Okay, so this is the deal. Okay, so it's 10:30 right now. Okay, so I can quickly go through these sheets if you want right now. If you guys want, we can go through these sheets. What I can tell you right now that a couple of you I want to collect more information, but let's go one by one here. Sorry, I'm okay with that. Let's see. Okay. Let me see. Okay. All right. Hold on one second. Okay. I'm going to bring up the sheet now. Hold on one sec. And what I'll do is share my screen again in a second when I get it up. And we can talk about it. Where is it? Wow. All right. Oh, okay. I see. All right. So this is So let's do this. Let's share my screen again. Okay. Now, everybody see this? So asking price is 282. Hold on. 282. Purchase price is 82.8. Number of units is 2. Gross revenue. Give me 1 second. Hold on a second. Sorry about that. Okay. All right. So let's do that again. I'm sorry. I did that and I do this for everybody. And you can remind me if you see it by accident. The name of the property was at the top of the sheet. I didn't want to do that. Okay. So it's not a big deal, but it's important that we have that kind of blocked. Okay. So asking price is 82. Okay. Purchase price is 82. Oh, no worries. Number of units is 2. Gross revenue is 15. Expenses are estimated at 30%. Net operating income is 11,000. We're looking at the financing 80. Seller financing 0. Out of pocket 20%. So we're assuming you're going to put the 20% down, right? Okay. So if we look at the financing, it's around 40 to 34 is the cash flow. If we come down here, we see cost per unit 41 GRM. It looks healthy. Cap rate looks healthy. Our value is 111, and cash flow per unit is 176. Cash on return is 25.6. Okay, so let me do this again. Okay, so do these numbers look healthy, everybody? Okay, I see that. I see that. You're borrowing the 20 from the, okay. So this is the thing that I want to do. At this stage, the part I need to understand better, we need to understand better is the expenses, what those actual expenses are, and what the actual interest that we're, what's the mortgage going to be. So for that, I want you to, oh, there it is again. Son of a gun. Okay, give me a second. Sorry. Okay, let's do that. Didn't see that. All right. Okay. Sorry about that, folks. I saw something else I didn't want to. I had to change. Okay. So we're good. Expenses are 104, 10,746 a year. Okay. So here it is. So that's going to change things for sure. Okay. So what I want to see, did you guys end up putting this in the cash flow sheet, the other cash flow sheet? How'd you get, oh, it's sent out, okay. Did you put that? Yes, sent it to you. Okay. So the other cash flow sheet, which I remember seeing now, hold on a sec. Let's go to, hold on one sec. Okay. So I got to stop sharing for a second, sorry. Is right here. I thought that's the one I pulled up. Okay. Okay. So when we crack down, and new folks, don't worry, we didn't go over this. We're going to go over this in the coming weeks, so don't worry. But this is a more in-depth cash flow sheet I'm going to show you right now. Okay? So give me a second. And that is right there. Okay? Enable and file. Do copy. No. Okay. All right. Okay, let's see if this works. Just going to change that to 111. All right. Okay. So this sheet I'm showing is more complicated for the new folks. Don't panic. It's okay. We're going to go over this sheet. I sent it to you. You just haven't used it yet, okay? Here we go. All right. So this is basically the property. We got 80,000, 2 units, 15,000. Then we looked at the expenses. Taxes, insurance, right? These are all, been confirmed. Condo fees, 5,000. Okay, but the vacancy, the maintenance, and the management. Now, vacancy's at 5. I like that because we're renting it. Not a big fan of condos unless we're going to flip them or rent home, but leave that alone for a moment. Maintenance, I don't want maintenance because you have condo fees, right? Maintenance and property management. I'm going to tell you to change that to, we're going to go 2, and I'm actually going to change this to 3, okay? Do you see that? Are you with me? Right? Do you see why I changed the maintenance to management to 2 and 3? Everybody know why? Why are we doing that? Because of this. Condo fees. Yeah. So condo fees cover the outside of the property, not the inside, but the outside. And that's huge. Right? And management is somewhat covered by them too. Right? The management of the property. So there's still going to be a cost, but we're just going to reduce it. Is it going to be the maintenance and the management? We can go 5% total, right? If we want to be a little more aggressive, we could go 3 and 7, which is 10, where this used to be 15. So let's go 3 and 7 just to give you an extra room. All right, total expenses we see here. Now see here, look at this. See, total operating expense is 61% of the income. That's not good, right? That means that most of our money is going to where? It's going to the expenses, not our income. Okay. Let's see if we do this though. That's a better mix. Let's stay with 2-3. Let's stay with 2-3. Okay. So net operating income. This is a little bit better. I'd like to see these opposite. I'd like to see the net operating income higher than the total expense, but that's okay. That's not the end of the world. Okay. 80% of the first mortgage, 30-year, 3.79. Second mortgage, none. But you know, you said you're getting that money from your line of credit, right? Right. Okay. So it would be you know, we could do something like this, and we did, which is 16,000, and really it's interest only you're paying, right? So what's the interest on the line of credit? $67. So let's go 6.5, and it's really not 6.5 as a payment because you're interest only. But you know, let's calculate it all, right? Let's calculate it all, you know, and give us just a number there. So it's about $100 a month. It's going to cost us. If we go down here, we see coverage ratios healthy, excellent, right? What does the coverage ratio mean? Well, it means that I have enough to cover. You know, I'm making enough money, income, this number here, to cover, you know, the carrying cost. This number, how much it's costing me to get a loan. That's where the coverage ratio says. So this is very healthy. 1.2 is what we need. You got 1.47. That's excellent. Cash on cash return is infinite because all the money's borrowed. Average profit per unit is $93. Excellent. GRM is 5. Excellent. Cap rate's a little low, but that's okay. It's not the end of the world. It's 8.8. Cost per unit doesn't really matter. It's 40,000. Coverage ratio. Okay, we already talked about it. Let's go back up here for a second. It's 80,000, right? Let's look at what it tells us it's worth. It says it's worth 70,000. That's not the end of the world. Not the end of the world, right? It just means that based on the income, you know, the cap rate, it should be around 70,000. So, you know, this is where we'd like to see that, you know, it drop a little bit for price, you know, and we'd have to see what we can do for price. I don't know if you talked to them about reducing the price or the property value. If, you know, if you could get it a little bit. Have you worked on the price at all? Not yet. Okay. Well, I'll tell you this. And look what happens when we get it for 70. The average per unit is 142. Let's just change this to 20 and 30. Let's say 6.5, and this was 3.8. So to get the right numbers here, let me see. 3.7, 3.8 is good. 6.5, 64, 16. Yeah. So based on that, if we could get it for 70, you see that your average profit per unit is going to go up to 117 versus the 93. Cap rate is at 10. GRM is 4.3, so it's lower. That's good. And the coverage ratio is even better, right? So this is a good example of where the banks would love you with this kind of deal because the coverage ratio is so high, right? Okay, yeah, sure, the comparables, sure, no problem, okay? So this down here is, you know, with VTB, without VTB. I don't know if you've talked to them about a VTB. You know, let me just remove this for a second. I want to check something. Because I changed those numbers. Hold on. So did you. That's okay. Anyways, have you asked them about a VTB at all? Vendor financing or anything? I know you don't need it, but have you asked? Okay. So this is what I suggest. I suggest that we go in and say, look, we're interested in the property. You know, what we'd like to, I would say, lock in this deal with an offer ASP. Okay. Go with the VTB. They will like that better return over time. Sure. So what I would say with this deal here is I would say, look, why don't we go at the person and say, look, we'd like to make an offer. We'd like to offer you $70,061 as a cash offer. if you're open to a VTB, vendor financing, we can go up to 80. Do you see that? Does that work? Does that make sense? You still with me? Now this is something that I want you. So 70, 61 cash, 80. Don't go 80 though. Go 81. But we need financing. You need financing from who? You mean the bank? No. See, the 80% is coming from the bank. Can you get that 80% from the bank? Well, pretty much, yeah, if you're putting up 20. You shouldn't have a problem. But if you're looking for a partner, say so. And I mean, someone on this call might want to be partnering with you. Or if you're looking for a loan at a good return, I mean, if someone is open to partnering? Is that what you mean? Open to funding. Okay. Is anybody interested in this deal and they can provide funding or portion of the funding? Justin, okay. Jamie, good. Wayne, okay. So this is what we're going to do. Okay. So let's do this. Let's first get the deal under contract. Okay. So 2 ways we can do this. We can go for it, get it under contract, and then negotiate terms, or we can try to negotiate terms and get it under contract. That's really a question of how much you believe you can push and pull on this deal without a contract. How confident do you feel about talking to the seller or the representative of the seller about price? Maybe a little wiggle room, but not much. Okay, why don't you do this? Find out what the wiggle room is. Pretty aggressive positioning as it is. Okay. Find out what the wiggle room is, and whatever it is, get it under contract. Anything under 80 grand, just get it under contract. And then we'll work on the rest of it later. Does that work? Okay. So when you do an offer to purchase, okay, so we're clear. When you say to them, I'll give you, once you work out the price, I don't care if it's $1,000 less. Whatever it is, let's get it under contract. Well, you're going to ask them for, this is what you're going to do. You're going to send them an email. You're going to send them an email. When you talk to them, say, look, if you agree to, say, 79,000, let's just pretend. Say to the realtor, because it's a realtor you're working for, right? You're talking to the representative. Okay, you're going to say, please send me, because they have it, not you. You don't need it. Say to them, please send me an offer to purchase contract for me to review with the agreed upon price. They'll send you an offer to purchase. Do you have a realtor yourself? Is your realtor on this deal? Not currently. Okay, well, I mean, the seller, it's up to you, but the seller is paying for the realtors, not you. So you can bring your realtor, or maybe the realtor that's representing it is doing this because it's not a huge property. They're going to be able to double end it and make more money. That's up to you. But you don't need your realtor. You might want your realtor, but you don't need your realtor. You just all you say to them is, I would like to make, an offer. Send me an offer to purchase. They'll put all the information in, and you're going to say, okay, I've reviewed it. Please put these clauses. Please put these clauses in the contract. And do you remember at the very beginning? So let's go over here. Do you remember at the very beginning? I talked about. these right here. Terms and conditions. You have a copy of this, right? Okay. Put these terms and conditions that apply, read over it, right? Because not all of them are going to apply to this property. Many of them are, though. Most of them are. Read over, put the clauses in that you want, and then before you send it back, you're going to send it to me to review, okay? Are we good? Okay. Sounds like it. Okay. So what are we going to do? Tell me what we're going to do. What steps are we going to do? Number one, we're going to call them back and try to, you said there was a little wiggle room, whatever the wiggle room is, don't fight over it, but whatever the wiggle room is, agree to it. Say, send me an offer to purchase. When they send you the offer to purchase, put all those clauses that you want to put in there, send it to me to read over, right, to look at with you, and then we're going to send it to the realtor and say, please put these clauses in. They're going to put these clauses in, you're going to get it under contract, okay? They'll have all the exits that we need to do if this deal doesn't work out, okay? Then, while we're doing due diligence, the inspection and other things, what you can do is you can connect with Wayne was on board and who else? Justin and Jamie were on board for possible joint venture or financing, okay? What you can do you have their contact information? No. Okay, so hold on a second.